So if we were to raise $100 million in debt, how would we link this through in the model? Where do we begin? Where do we drive this debt raise in through the model? How do we start? So let's do it with Walmart, but first let's talk about it. What would be the implication? We are raising $100 million in debt, 10% interest. We talked about the impact to the income statement, cash and balance sheet. How do we do it in the model? You could start with cash flow. Where does this come from in the model? Yep, and where does that come from in the model? Yep, and where does that come from in the model?
From debt schedule.
Debt schedule. Where in the debt schedule?
Raise of new debt.
The issuances and retirements. This comes from the debt schedule. What about impacting the interest expense? Debt schedule. Right? The interest expense is already impacted. Once we go to the debt schedule and hard code in issuances and retirements, that will flow into the financing activities, which will flow into the debt balance and cash. It'll also increase our interest expense, which will automatically flow into our income statement and make all these adjustments. So our standard model is already designed to handle a debt raise. We just have to make sure that we know the movements for your financial modeling knowledge. Right? And it's important to, this method, when you're doing complex transactions, spin-offs and roll-ups and things like that, it's important to draw it on the board like this, and then ask yourself, all right, well, how do I go in and make these changes? And what I would recommend is just picking any point and tracing it back to a source. So here I know, all right, well, I know since I drew this out that the debt balance must increase. I know this must increase. Where does this come from in the model? This comes from your cash flow statement. Where does this come from in the model? This comes from your issuances and retirements. Where does that come from in the model? That's hard-coded. So my recommendation is when doing complex transactions is to draw a roadmap like this, pick significant points that you know need to be impacted, and trace it back to its source. Again, I know interest expense must be impacted. Where does this come from? This comes from the debt schedule. Where in the debt schedule? In the interest expense. How's that calculated? That's the average of the debt balances. What impacts that? The debt raise. So you know if you hard-coded the debt raise, all these pieces will be impacted. So let's do it. Let's prove it. So if we go into the model, the Walmart model, let's say we want to raise 100 billion, I guess, just to illustrate movements. And we know interest expense must be impacted. How does this change? This is driven by the interest rates. Let's do it in 2017, yeah? Let's do long-term debt. So we said if we increase the issuances by 100 billion, let's see what the impact is. I want to know what the impact is to E.P.S. so we can compare it with an equity raise scenario. So what's E.P.S? E.P.S in 2017 is $6.18 basic. So $6.18 base case. When we raise debt, we predict it'll go which way? Down. By how much? How much down will it go when you raise debt? How much will your E.P.S. reduce by? Your after-tax interest. More or less. More or less. Other things go into that too. But the major movement is the interest expense. The impact to E.P.S. based on raising debt is the impact of interest expense. Interest expense is tax deductible, so it's the interest expense times 1 minus tax rate divided by shares. That is the E.P.S. impact. Let's prove it. And then we'll compare how this differs from raising equity. So if we were to raise 100 million, or 100 billion, represented by 100,000. Debt goes up, interest goes up. What else should happen? Our debt balance should go up on the balance sheet. It should still balance. Our cash balance should go up on the balance sheet. Let's take a look. Debt balance goes up on the back. Cash has gone up to 100 billion. Long-term debt should go up from 44 to 144. Yes, it does. Interest expense should go up to 4 billion. It jumps. Yes, it does. Notice interest income has also gone up because we have more cash on the balance sheet. EPS has dropped to 596 from 618. So in the debt case, gone down to 596. Okay? It's dilutive. It's dilutive because of the impact on interest. You okay with that? Okay. Let's zero this out and let's talk about how this differs between raising debt and raising equity. So I'm going to zero that out. Okay, so when raising equity, we suggest it may or may not be more dilutive than raising debt. Right now, the dilution in the debt raise is 22 cents, right? 22 cents dilutive. What happens when we raise 100 million in equity? So the first question is, we talked about the impact of raising equity. How do we do this in the model? Where do we go? That's for debt.
It's in the little share box thing that we have under the interest rate.
Okay, you need to increase shares, right? So you need to increase shares. So we need to kind of make an assumption to increase the shares. What else do we need to do? Cash flow from financing. Again, pick a point and trace it back. We know stock needs to go up. Where does this come from in the cash flow? Where does this come from? This comes from the cash flow statement. Issuance of stock. Where does this come from? It's hard-coded. This is where we begin. We need to raise stock. We'll hard-code 100 million in the stock case. We got to do some modeling though. I don't think Walmart was set for equity raise. So let's take a look. So we're going to go into the model. We're going to go to what do we know would be impacted by raising equity? It is the shares, the common stock plus additional paid in capital. Right now it just equals F34. There is no cash flow statement line item that's been set to impact this. But we know this should be an increase in our financing activities. That should increase this. So we need to model this out. So we need to go into our cash flow statement. We need to create a line for issuances of stock. Let's see, is there nothing there? No. And you know what? Why didn't I not do? Go ahead. I didn't put the little header there. There's a line where? Purchase. Nope. For issuance of stock? I don't see anything for issuance of stock. Let's make one. So I'll do it right above line 33. So you can do shift space to highlight the whole row. Control shift plus. And I'll call it issuance of common stock. Or whatever you want. Historically, it'll be 0. It's actually going to be 0 all the way because these are our projections. But in 2017, I want to model in 100 million. This is actually 100 billion. Okay, so issues of common stock, 0 all the way through. And we want to make sure our totals are including this new line item. It's 100,000 representing 100 billion. So my totals, okay. So my total did not include that, so I want to add to my total plus 100 million. Just make sure you're adding that in. So it's properly impacted. And I also want to make sure that my total, that works. I want to make sure that my total cash before that pay down also includes that line item. It's a new line item. You want to make sure your totals include that. Okay, so make sure you have this. I'm going to save this as a 10-1 model. Okay. Good. And this equity raise should impact the balance sheet. It's certainly impacting cash, which will drive cash, but we're probably not going to balance because what? Because how is that balancing? Oh, right. It's not balancing the last year. Yeah. Because we did not link in the potential equity raise into our model. And every time I model out a scenario like this, I want to make it robust and build it out so that I can design the capabilities of having this in any year. Right? So I would never just do 2017. I wouldn't do something in 2017 that I haven't done in the years prior. You're just leaving yourself prone to errors. So in any year, if I were to raise debt in any year, equity, I'm going to go down to the common stock plus additional paid-in capital, which right now is just equaling the year before. Now it's going to equal the year before plus the potential debt raise. So I'm going to append this formula to say equals F34 plus, on the cash flow statement, this new equity raise line item, which I have as G33. And so when I copy this to the right, it should show me that I'm raising 100 million in 2017, and I should now balance again in 2017. Now we have the first component. We have cash going up, cash goes up, the equity balance goes up, it balances. What about the impact to shares and dividends? We got to go to the income statement. Okay, so we go to the income statement. So right now we have shares being bought back. Again, don't forget, if you're ever modeling out in your cash from financing activities something to do with adjusting shares, either buying shares, selling shares, you need to impact the stock. A lot of people forget that. A lot of people just use the 7 methods and treat financing activities as other, taking the last year, and they forget to have to go back and retroactively impact the share count accordingly. I'm going to add a row to represent the stock issuance. So right above cell 52, I'm going to do Shift Spacebar, Control Shift Plus. I'm going to do Share Issuance. Okay. How would I model this? Just write a note to myself to next week. Yes, Daniel.
Can we work with the assumption that you'll be using the current stock price?
Yes, let's use the assumption that we'll raise it at the current stock price. Some people do like a 5% discount to the stock price, but let's just do it at the current stock price.
Why would you do it this stock price?
Usually if you're going to raise like $100 billion, you'd sell it in the primary markets at a discount to convince funds to buy it in bulk.
Oh.
And that's usually why in acquisitions the acquirer stock price would reduce slightly.
Wouldn't you buy it at a premium because you're trying to convince people to sell it to you?
You buy the target shares at a premium.
Shares, you're putting more.
So you're issuing your own.
Right.
You may want to issue at a discount to ensure that you're getting your funding needs. And we'll get into that more with M&A and the purchase price and stuff like that. So, Brian, yes?
Since we are issuing more stock, is currently what we have done with, we have not to go back and buy new stock, or is it so if you're not, you mentioned that we're going to be buying back stock.
No, we're not going to be buying back stock. We're raising stock.
Oh,
Yep.
So
The funds will be buying it.
Oh.
Yep. We're selling it.
So for $100 million worth of equity at the share price of 73.82, that's an additional 13.54.
How'd you get that?
Just divided.
Divide. Yeah. So let's divide. So we're going to divide the stock raised by the price per share. I want to raise $100 billion at, let's assume, the current share price. So I'm going to take $100 billion divided by the current share price. But I want to build this to be able to raise stock in every year. So my share issuance is going to be pulling from that new share issuance line item, which represents money raised, divided by the current stock price. So I'm going to go equal to cash flow statement, the issuance of common stock, divided by the current share price. And this current share price, I'm going to anchor. I'm going to hit F4 to anchor the reference to the stock to this price. So when I copy this to the right, obviously, I don't want this to shift into empty cells. So this is going to be equal to cash flow G33 divided by D54. And so when I copy this to the right, it's going to be 0, 0, 0, 0, of course, because I'm not raising stock here. But now this model is now designed to be flexible. If I decide to raise stock earlier, now the model can work that way.
So should we be keeping it like that, or should we round it up?
I'd keep it like that because these shares are not natural numbers. Yeah, I wouldn't round it. I'd round it if it was actual numbers. So what I want to do is right now I have my formula equals the 2013 minus the share buyback. I want to add the share issuances to it. I'm going to add the share issuances to the share buyback. I'm going to do it in 2014 forward. And I'm going to do this, so it's going to be 2014 says equals G49 minus H51 plus the share issuances. And I'm going to do the same in the diluted. It's going to be the year before minus 99 plus the share issuances. Right. So we're adding the share issuances. So in 2017, the share count is going to go up by the dollars raised. Same with the diluted shares. Diluted shares right now says equals year before minus what's bought back plus the shares issued. Share count goes up.
Can we go to the formula for 2013 and then basic?
Well, this is the reason why we can't. I should probably delete these. The reason why we can't do it in 2013 is because we've calculated these based on our financials.
No. We cannot do the whole thing for 2013.
I guess we could. We could just add here to add it. Yeah, we could just tack on that plus any new issuances. Sure. I guess there's no reason why not. Do that.
The buybacks.
The buybacks are already included. Yeah, that's the thing with the buybacks. No, that was a little bit of a, yeah. The issuances, yeah, you're right. This is all in chapter 3 of the M&A book. So we'll spend some time going through this. I will recommend that you start to read that. Nice. And in the M&A book, they'll go through the Office Depot model doing this. So more practice. You can go through doing this all over again with Office Depot. We won't do that in class, so it's extra practice. Okay, what impact does this have to EPS? Goes down to 442. Right? Went down even further. Went down from 618 to 442. Much more dilutive than raising debt. Why is it more dilutive than raising debt? Why is it more dilutive than raising debt?
Well, you're on the tax shield.
And not the tax shields. Why else? Does that make sense? Does it make sense as more diluted than raising debt? What impacts dilution by raising equity? Yes, Tyler.
So the impact on the changes in shares was much bigger than the changes in net income.
So what drives dilution in raising equity is the raising of the shares, which has a greater impact than raising debt. And continue.
And maybe the reason for that is that you issue stocks one time for example, we issued like 100 million, yeah,
Mhm.
way. And in case of raising debt, we pay interest on an annual basis. So the impact on net income is less.
Is less?
The calculation.
How do you quantify that? How do you quantify the impact? Yeah, Johnny. Well, the cost of debt and the cost of equity. Cost of debt of raising the debt was 4.75%, the interest. The impact of the cost of equity? You can look at the inverse of the PE. What's the PE here? What is the PE? Let's do it quick. It was 73.82 divided by, I'll do the base PE of 618. 12. That's the PE. So the inverse of the PE, 1 divided by 12 is about, and that's a crude kind of way of looking at it. I wouldn't do it as the 8%. What cost of equity did we calculate, actually? Walmart. In our DCF analysis, we calculated cost of equity to be much, much lower. It doesn't always work that way, but still, it's still higher, right? It's still higher than the cost of debt. Why is it higher than the cost of debt? Equity holders get paid. Equity holders are taking on more risk, so they expect a higher return. So subjectively, you would expect that raising equity would be more dilutive because you're giving out a bigger piece of the pie. Because investors are demanding it. And how are they demanding it? In the share price. They're demanding it by setting the share price appropriately so that they're getting a larger share of earnings rather than when raising debt. This isn't always the case, though. So we'll look at when this is not the case and why. But just understand for now the drivers behind raising debt and raising equity. Raising debt has an impact of tax-affected interest, the tax-affected interest rate. Raising equity has an impact of dilution in shares. And usually raising equity is more dilutive than raising debt because the investors are pricing in the added risk to raising equity. Raising equity, they don't have the first rights if the company goes bankrupt to return. So the general adjustment is raising equity is more dilutive than raising debt because raising equity is more risky. The technical drivers of E.P.S impact when raising equity is the increase in shares, raising debt, the increase in interest. So let's start there, and we'll look at cases where this is not the case. But this is important because in M&A, the first stage of impact, and the first thing you'd look at, and investors want to look at, is what is the impact to E.P.S in this acquisition? And the first step to that is how they're funding it. Are they raising equity? Are they raising debt? What's the impact to that? Yes, Gianni.
Besides that equity gets paid later than debt, what are the reasons that equity is more risky than debt?
Anyone else? Other reasons equity is more risky?
Well, in this scenario where we need to, like we're closing, that's paid back before equity.
In addition to the payback, in addition to the priority.
Value can fluctuate.
The volatility, it's the liquidity. That all prices into the risk. Yeah.
That also affects the residual funding.
Yep.
If you're not getting enough earnings, that way you
That's true. But yeah, the major other component is the volatility of that stock, right? It's liquid. Right? The stock price can fluctuate depending on headline risk, depending on a lot of other factors, right? So risk, volatility would all impact your return, which is impacted by a lot of other things. Headline risk, litigation, anything that might impact would fluctuate the stock price dramatically, whereas your coupon payments on a bond will stay consistent despite all that. Okay, good place to stop.